Today we will talk about the global capital market. This chapter discusses the interconnectedness of global capital markets, emphasizing the importance of functions such as borrowing through commercial paper issuance and the role of market participants worldwide. The efficient operation of these markets is crucial for the global economy, as demonstrated during the 2008 financial crisis, when the market for short-term commercial paper nearly froze. Government interventions helped stabilize the situation. The chapter explores the benefits of the global capital market, highlighting its role in connecting investors and borrowers. It examines the limitations of domestic capital markets and the advantages of utilizing global capital markets. Various market segments like the euro currency market, international bond market, and international equity market are reviewed. Market makers, including commercial banks and investment banks, facilitate connections between investors and borrowers, either indirectly through deposits and lending or directly by charging commissions for their services. Capital market loans to corporations can be equity loans through stock sales or debt loans, repayment of principal plus interest. Stockholders receive dividends based on a company's profits, while bondholders receive fixed income for a specified period. Stock prices reflect expectations of future earnings, while debt loans have predetermined repayment terms. This chapter sheds light on the functions and implications of the global capital market for international business practices. Global capital markets offer significant advantages to both borrowers and investors. Borrowers benefit from a larger pool of funds and lower borrowing costs, while investors gain access to a wider range of international investment opportunities, enabling them to diversify risks more effectively. By connecting participants across the globe, these markets create efficiencies that are often unavailable in purely domestic settings. From a borrower's perspective, the global capital market provides access to greater liquidity, which reduces the cost of capital. In domestic markets, the limited number of investors restricts the supply of available funds, often driving up the cost of borrowing. This includes higher interest rates on debt and greater expected returns on equity. In contrast, a global market expands the pool of potential investors, enabling borrowers to secure funding at more competitive rates. For instance, Deutsche Telekom raised over $13 billion by simultaneously offering shares in multiple international markets, leveraging the larger pool of global investors to lower its borrowing costs. Even enterprises in advanced economies with robust domestic markets benefit from global capital markets. Limited liquidity isn't confined to less developed nations. Companies in highly industrialized countries, such as Germany, have increasingly turned to international capital markets to meet their funding needs. By accessing the deeper and more liquid global market, businesses can borrow more funds at lower costs, facilitating growth and competitiveness. Benefits of international portfolio diversification. The global capital market offers investors a broader range of investment opportunities, enabling them to diversify internationally and reduce risk beyond what is possible in a purely domestic market. Diversification mitigates the risk associated with individual investments by balancing losses from underperforming assets with gains from others. International diversification is particularly effective because stock markets in different countries are not perfectly correlated, often responding to unique macroeconomic conditions. How diversification reduces risk. Investors benefit from lower risk as they increase the number of stocks in their portfolio. Domestically, diversification reduces risk rapidly at first, but the decline slows and ultimately stabilizes at the systematic risk level, risks stemming from macroeconomic factors that affect all firms. International diversification further reduces risk because movements in global stock markets are only moderately correlated. For instance, historical studies show that the correlation between U.S. and international stock indexes has been relatively low, allowing investors to mitigate risk significantly by holding foreign stocks. Barriers and challenges. The low correlation across countries is due to differences in macroeconomic policies, economic conditions, and capital controls. However, these benefits are sometimes constrained by barriers such as limits on foreign ownership or restrictions on cross-border investments. Additionally, volatile exchange rates under the current floating exchange regime add an element of risk, as adverse currency movements can erode returns from otherwise profitable foreign investments. Trends in global integration. Despite the benefits of international diversification, increasing global economic integration has led to greater correlation among stock markets, especially during major crises like the 2008 financial downturn. However, research suggests this convergence is gradual and varies across countries. Emerging markets, such as China, continue to provide new opportunities for diversification, reinforcing the value of including international assets in a portfolio. While currency risks persist, the potential to reduce volatility through international diversification remains significant for global investors. The global capital market has expanded significantly, with data indicating substantial growth in cross-border bank loans, international bonds, and equity offerings. By late 2010, cross-border bank loans reached $532.4 billion. International bonds totaled $26.6 trillion, and equity offerings hit $750 billion. This growth can be attributed to two main factors: advances in information technology and government deregulation. The financial services sector is heavily reliant on information, utilizing vast amounts related to markets, risks, and financial assets. Since the 1970s, technological advancements have transformed this industry, enabling instant global communication and enhanced data processing capabilities. Notably, the cost of recording and transmitting information has drastically decreased, facilitating the emergence of a continuous, integrated international capital market that operates 24/7. However, this integration comes with risks. Financial shocks in one region can rapidly affect global markets, as demonstrated by events like the 1987 stock market crash and the 2008 financial crisis. Despite these risks, many market participants believe the advantages of a global capital market outweigh the downsides. Furthermore, while national market shocks can spill over internationally, the overall correlation of equity movements remains relatively low, suggesting limited long-term impacts beyond the originating market. Historically, financial services have been one of the most heavily regulated industries, with governments limiting foreign market access, segmenting domestic markets, and restricting both inward and outward capital flows. Examples include the U.S., prohibiting overlaps between commercial and investment banking, and strict capital controls in the UK during the 1970s. However, starting in the 1980s, Deregulation became a global trend, driven by the rise of the euro currency market, pressure from financial firms, and increasing acceptance of free market ideologies. Key milestones include the U.S. allowing foreign bank entry, the UK's Big Bang of 1986, and similar liberalizations in Japan, France, and Germany, which transformed financial services into global operations. Alongside deregulation, countries began dismantling capital controls, encouraging international investment. This trend expanded from developed nations to emerging economies in Latin America, Asia, and Eastern Europe by the 1980s. The 1997 WTO agreement further boosted global capital market growth. However, the 2008 to 2009 financial crisis highlighted risks, questioning if deregulation had gone too far, especially in unregulated sectors like hedge funds. Despite these concerns, the globalization of capital markets is expected to continue, bringing both opportunities and risks. Analysts worry that deregulation and reduced cross-border capital controls make nations more vulnerable to destabilizing speculative capital flows, or hot money, which pursues short-term gains and reacts quickly to changing conditions. Harvard economist Martin Feldstein highlights the scarcity of patient money, which supports long-term investments, attributing this to limited information about foreign assets. This information gap discourages cross-border investment and amplifies instability, as seen in Mexico's 1990s economic issues caused by volatile capital flows. Differences in accounting standards further complicate cross-border investment comparisons. For example, Daimler-Benz's financials in 1993 showed a profit under German rules, but a significant loss under U.S. rules. Recent harmonization of global accounting standards has improved transparency, encouraging more informed investments. While many investors remain cautious, better information from financial intermediaries could reduce speculative flows and improve decision-making as global capital markets grow. Despite concerns following the Asian financial crisis, IMF research shows no significant rise in financial market volatility since the 1970s. Now we have the euro currency market. A euro currency refers to any currency banked outside its country of origin. For example, euro dollars, U.S. dollars banked outside the United States, constitute about 2/3 of all euro currencies. Other examples include euro yen, euro pounds, and euro euros. Despite the euro prefix, this market operates globally, reflecting its European origins. The euro currency market provides an essential and cost-efficient funding source for international businesses. The euro currency market emerged in the mid-1950s when Eastern European countries, including the Soviet Union, began depositing dollar holdings in European banks, particularly in London, to avoid potential U.S. government seizure. Western European central banks and exporters to the U.S. also deposited dollars in London for higher interest rates. The market gained momentum in 1957, when British banks, restricted from lending British pounds for non-British trade, started using dollar deposits to finance international trade. London subsequently became the hub of euro currency trading. In the 1960s, U.S. regulations limiting dollar loans to non-residents further drove international borrowers to the euro currency market. After the 1973 collapse of the Bretton Woods system, U.S. Policy changes reduced reliance on euro currency markets. However, OPEC's oil price hikes in the 1970s led Arab nations to deposit surplus dollars in London to avoid potential U.S. asset freezes, significantly increasing euro-dollar supplies. While political events played a role, the market's growth was primarily due to its financial advantages for depositing and borrowing currencies, which continue to attract global participants. The attractiveness of the euro currency market lies in its lack of government regulations, enabling banks to offer higher interest rates on euro currency deposits and lower rates on euro currency loans compared to domestic currency transactions. Domestic banking in industrialized nations is subject to reserve requirements to ensure liquidity, which limits the amount banks can lend out from deposits and increases operating costs. In contrast, Eurobanks face fewer restrictions, allowing them to lend out the full amount of deposits and offer more competitive interest rates. For example, a New York bank with a 10% reserve requirement can only offer an 8% interest rate on deposits to cover costs, while a Eurobank can provide a 9% rate and still cover expenses due to no reserve requirements. This competitive advantage extends to loan rates as well. Companies benefit from higher deposit rates and lower borrowing costs in the euro currency market, prompting the question of why any depositors would hold funds in their home currency rather than capitalizing on better yields in the euro currency market. The financial incentives driving companies to utilize the euro currency market are clear, raising the question of why its growth hasn't been even more rapid, given the significant advantages it offers. The euro currency market has two main drawbacks: higher risk of bank failure and foreign exchange risk. Higher risk of bank failure. Unlike regulated domestic banking systems, the euro currency market lacks strict oversight, increasing the probability of bank failures that could result in depositor losses. While this risk is still relatively low, the lack of regulatory protections, such as reserve requirements, makes some depositors hesitant to participate. The lower interest rates in domestic systems partly reflect the costs of ensuring greater security and liquidity, which some depositors prefer. Foreign exchange risk. Borrowing in foreign currencies through the euro currency market can expose companies to currency fluctuations. For instance, if a U.S. company borrows euro pounds and the pound appreciates against the dollar, the cost of repaying the loan increases, raising the company's overall capital costs. While the forward exchange market can provide partial insurance against this risk, it does not eliminate it entirely. Consequently, many companies prefer borrowing in their domestic currency to avoid this uncertainty, even if euro currency loans offer lower interest rates. The global bond market has experienced significant growth since the 1980s, serving as a critical financing tool for many companies. The two main types of international bonds are: 1. Foreign bonds. These are issued outside the borrower's home country and denominated in the currency of the country where they are issued. For example, Yankee bonds are foreign bonds sold in the U.S., samurai bonds in Japan, and bulldogs in the U.K. Companies often issue foreign bonds to benefit from favorable interest rates, such as Japan's low rates in the late 1990s and early 2000s. 2. Eurobonds. These are bonds denominated in a currency different from that of the country in which they are issued, and are underwritten by international syndicates. For instance, a German company might issue dollar-denominated Eurobonds sold outside the U.S. These bonds are popular among multinational corporations, governments, and international institutions, and are typically marketed in multiple countries simultaneously. Historically, Eurobonds dominated the international bond market, but foreign bonds are becoming increasingly prevalent. Companies opt for international bonds to reduce borrowing costs by taking advantage of favorable conditions in specific markets. The Eurobond market offers three key advantages that make it an attractive alternative to major domestic bond markets. 1. Absence of regulatory interference. Eurobonds fall outside the regulatory control of any single nation, unlike bonds issued in a country's own currency. This lack of government oversight typically reduces the cost of issuing bonds, making Eurobonds a more affordable option for issuers compared to domestic bonds subject to national controls. 2. Less stringent disclosure requirements. The disclosure requirements for issuing Eurobonds are generally more relaxed than those in national bond markets. For example, firms issuing bonds in the U.S. must comply with strict SEC regulations, including detailed disclosures of financials and executive compensation. This process can be expensive and time-consuming, especially for NON-U.S. companies. In contrast, Eurobonds, including those in U.S. dollars, often bypass these burdens, making them a cost-effective alternative. 3. Favorable tax status. U.S. laws were amended in 1984 to eliminate the 30% withholding tax on interest payments to foreign holders of U.S. Eurobonds. This move made Eurobonds more attractive to foreign investors, as did similar tax reforms in other countries like France, Germany, and Japan. These tax advantages increased demand for Eurobonds and encouraged international investment. Historically, regulatory barriers limited the ability of companies to raise capital internationally or list shares on foreign stock exchanges. These barriers began to fall in the 1980s and 1990s, allowing firms to access global equity markets, list shares on multiple exchanges, and raise funds internationally. For instance, German companies like Daimler-Benz and Deutsche Telekom raised substantial funds by issuing shares on foreign stock exchanges in Singapore, Frankfurt, London, New York, and Tokyo, seeking larger, more liquid markets to lower their cost of capital. In recent years, many Chinese companies have also turned to foreign markets, such as the New York Stock Exchange, to raise equity at lower costs. This trend has increased the globalization of equity markets, though each country still has its own domestic stock market. While U.S., British and Japanese markets remain dominant, international investment and corporate ownership are growing. Increasingly, investors diversify portfolios by investing in foreign equity markets, and companies broaden their stock ownership by listing on foreign exchanges to raise capital, gain liquidity, and facilitate future acquisitions. This trend is also seen in developing countries, where companies with limited domestic market liquidity are listing their stock abroad. Firms from countries like the Czech Republic have turned to markets like the London Stock Exchange to raise equity capital. Foreign exchange risk can complicate a firm's decision to borrow funds from the global capital market, even though the cost of borrowing may be lower compared to domestic markets. When a firm borrows in a foreign currency, adverse fluctuations in exchange rates can significantly increase the cost of the loan, as seen during the 1997 to 1998 Asian financial crisis. For example, A South Korean firm could borrow 1 billion won domestically at 10% interest, or borrow US dollars at 6% interest, saving money by borrowing in dollars. However, if the won depreciates against the dollar, the cost of repaying the loan in won increases dramatically, as happened during the crisis when the exchange rate moved from $1 equal W1,000 to $1 equal W1,500. This resulted in a significant increase in the firm's borrowing costs, from 6% to 59%. To mitigate this risk, firms can use forward contracts to lock in an exchange rate, which can protect against unfavorable fluctuations but increases the cost of capital. However, many borrowers did not hedge their loans in 1997, leading to defaults when their currencies collapsed. Ultimately, while borrowing in foreign currencies can offer lower interest rates, firms must carefully consider the risk of currency fluctuations and the possibility of higher borrowing costs. The forward exchange market offers limited protection, especially for long-term loans. The last topic we will talk about is managerial implications for growth of the global capital market. The growth of the global capital market presents significant opportunities for international businesses to borrow and invest. Firms can access lower borrowing costs in the global market compared to domestic markets, regardless of whether they use equity, bonds, or loans. This cost advantage arises from the global market's liquidity and minimal government regulation. However, borrowing in foreign currencies carries foreign exchange risk, which can offset these benefits. On the investment side, the global capital market enables diversification of portfolios across nations, reducing overall risk more effectively than purely domestic investments. Yet, foreign exchange risk remains a complicating factor. Looking ahead, the global capital market is expected to grow in importance and integration, with potential developments such as a unified capital market and common currency in the European Union enhancing internationalization. These trends are likely to create more opportunities and benefits for businesses.
Thank you for watching. If you liked this video, please like and subscribe to channel.